planning. And we've done a little bit of work this semester on, talking a little bit about stocks and bonds and the stock market and everything. But this, we've sort of done that peripherally. This is really dedicated to those topics. So first off, let's just talk a little bit about what investing is. I feel like everybody's probably got a raw understanding of it, but it's the act of, mindfully putting money into some sort of instrument. And when I use the word instrument, that is synonymous with stocks or bonds or money markets or real estate. An instrument is just the vehicle that you use to channel your money into something that's going to generate a return. Okay, now make sure that you understand, we haven't probably used these words for a while. I know that I said it earlier in the semester, but a return and a yield are the same thing. So if I ask you like, hey, you bought a duplex, what's it yielding? And Carson might say 6%. My real estate investment is yielding me 6%. And then, hey, Gabe, you've got a money market. What's that returning? Okay, same question. He goes 2%. And then I'm like, hey, Philip, what's your stock portfolio yielding? Well, right now, I don't know if you've been following the stock market. I mean, it does a whole bunch of this, right? Tech stocks have been really depressed because we've had a lot of pressure on big tech companies after the election and shutting out certain people from continuing to use social media platforms. And they've been called before Congress, and there's been a lot of heat on them. So tech stocks are down. Or I might say to Cameron, hey, what's your bond investments returning? So those are the kinds of questions you can ask. So investing is like this really methodical process of trying to balance all those things I just talked about so that you get something that is productive, but also safe for your level of risk. This word right here, speculating, whole different word. That's kind of like going to Vegas, but you're playing, with money on the market, right? So when you go up, to play craps, or you go up to play roulette, or, play whatever, 5-card stud, you've got, what's the big game around place? Oh, blackjack. There's odds. I mean, it's all statistical, right? So you basically know your odds, but the opportunity to return anything that's predictable is low, right? It's low. So that's speculating. It's highly uncertain. You can walk away from the craps table with a couple grand. You can lose the 500 bucks you came to the table with. So that's really the same thing with the market. Brandon talked about different companies being rated differently, like, AA or A or BB. It's the lower the rating, like C, CC, D, those are called junk bonds or junk instruments. And you'd be like, well, who would ever invest in those? Who would ever invest in those? Anybody have an answer to that? Why would you invest in something that's got the word junk right in the title?
People with money to burn looking for like a spike in stocks. They're like speculating that, say, like the tech sector is going to get a huge boom. So they invest in like a junk stock in tech, and then it just booms, and then they sell right away.
Exactly it. You invest in something that's got a low rating because you're speculating and you want really high returns. Okay, you're not investing in a junk bond to get 3% a year. Excuse me, I spilled my water on. Then they're also saying here that before you invest, you should have sufficient savings. And we've talked a lot about savings. The goal is to get up to at least 3 months of living. And we talked about doing that every month by setting up a separate savings account and moving that 50 bucks or 100 bucks a month into that. You should really get to that point of liquid savings before you go in to an investment portfolio. However, with that said, you may, and hopefully you will, your first job out of college, hopefully will have like a 401k, right? Or a SEP or a simple or something where your employer helps match the money that you put in, and you're gonna have to make investment decisions in that 401k. Can anybody unpack that for me? What am I talking about? Because I have a sense that students think that the 401k is the investment. What is a 401k?
It's like a savings, a tax exempt savings account that can be invested by the company.
Okay, by the company, meaning who?
Your employer.
Okay, you invested.
Well, don't you, part of a paycheck is taken out and placed into it and they match it, and then it can be, I mean, it can just sit there and not necessarily make interest, or it can be invested in low risk.
It has to be invested. So what happens, you're 99% of the way there, Gabe. You have a paycheck. I'm like, I want $50 a check coming out. And my employer's like, I'll do a dollar for dollar match. So now I've got $100. And when it goes into my 401k, that's just a fancy word for what you said, tax deferred savings. Now that has to go somewhere. It might just go to a money market account and earn, 0.02%, but you have that choice. And when you're young, you probably want to take more risk with that. You want that $100 to be maybe in tech stocks, right? And hopefully, I'm sorry?
So you actually get to choose like what markets it's getting invested in?
You do, but what your employer does for you, Gabe, is he or she chooses a package of what you can choose from. So let me make sure you guys understand the difference. If I have my own like investment account, say I've got $10,000 that I just have in a liquid investment account, I can buy and sell individual stocks, bonds. I can go into Singapore and Bolivia. I can do whatever I want, right? It's liquid money. I've got limitless choices. At the University of Montana, for example, we've got 5 funds we can choose from. Do you want to be in the global stock market? Do you want to be in bonds? Do you want to be in a very safe, like money market type account? Do you want to be in, I think there's like a United States stock fund, and there's 5 choices. I mean, it's super limited, okay? So that takes away, I'm not having to like overthink all these micro markets. I just allocate my money between those 5 funds. Once you make the decision, Katie, like to make that allocation, so you're in your 20s, I assume. I hope I'm not speaking out of place. So say you get your first job out of school and you put your $50 a month in and your employer matches the $50. What are your choices going to look like if you and I work together compared to me? Are we going to make the same choices how we divvy up our $100 a month? You got to turn on your mic, honey.
Probably not.
Why not?
Because I have like a longer period of time to save more money.
Of course you
And
You go ahead. I'm sorry. Go ahead.
no, it's okay. Never mind.
No, but so it's not just that you have a longer time to save, it's that you have a longer time to do what? What happens to the market, you guys? Does it go like this?
Over a long period
Carson,
of
what
time.
happens to the market over time?
It fluctuates, but over time, doesn't it generally go up?
Yes. I mean, in your lifetimes, lots of you are quite young, but just in your lifetimes, we've had 2 huge global hits to our markets, haven't we? We had the recession of 2008 with all the toxic mortgages and and TARP and, the banks all shutting down. And then we've had a global health pandemic. I mean, that's pretty big stuff for freaking 12 years, okay? And both of those times, well, actually, that's not true. The pandemic's been sort of weird. The market's still gone up. But in 2008, the market was at like, I don't know, I can't even remember exactly, like 13,000. And it went all the way down to 7. So that means every single one of us that had investments opened up our statement. And it was like, you thought you had $200,000, you had 100. So that happened to me when I was in my late 40s. And I was like, why was I like, late 40s, I saw everything that I owned was half.
You
Why
had
did I
time
not-
to build it back up.
I know I'm not retiring until 65. I had 18 years left. I mean, it wasn't particularly pretty to see on paper, But it's like, I know just what Carson said, the market goes like this, but over time, it yields about 7.5%. And so, okay, great. So when Katie says she's got longer to save, it's not just that she has longer to save, she has tons of time for this to happen with no worries whatsoever. I've got no time for that to happen with no worries. So what do you do when you're older?
Do lower percentage or like lower risk.
Yeah, you start moving stuff into like very safe instruments. Okay.
Lisa, I was wondering, do they usually actually max out at like 401k, like in terms of money, or is that kind of just a generalized term?
I'm sorry, say that one. What do you mean maxed out?
Do they actually like you can only put in up to $401,000 or?
There is a max. It changes every year. It's in the tax code. And God, this is pathetic. I don't even really know what it is right now. It's around 21 grand. You can put away around $21,000 a year.
But so like total, there's not like
Yes.
a cap. Well, like
That
there's
is the cap.
or right, but per year, but like, oh, I guess it would kind of have a cap, but over your lifetime,
Yeah.
it's not like max. Okay.
No, like if you started working at 16 and worked till you were 80, you know, you'd have a different cap than me who worked for 25 years. And then also to answer this question, so what about the match? Can anybody tell me what that looks like? Is it a mandatory match? Is it always dollar for dollar? Is it, how does that work? Anyone know? Ever heard of it? This will be arguably one of the more, well, first off, let me make a statement. You will be, particularly your generation, this is my opinion, this isn't a statement of fact, this is my opinion, but I think I could probably find research that backs it up. You should be, or you will be, as a whole over your career, more concerned with your benefits than you may be with your compensation. Why would I make such a bold statement as that? And that did not describe my generation. Why did I make such a bold statement as that? Any ideas? So Alexis, what do you think is one of the things, or what is one of the things you're going to be most concerned with, say, the next 40 years?
I'd say repaying student loans is probably on the top of the list.
Okay, fair enough. And that's just going to take flat out cash. Yeah. Although, did you guys all hear that part of the American Recovery Plan is an up to $10,000 forgiveness on student loans? So I wish I could advise you further. Have you gotten any outreach from your student loan providers on it? No, okay. I guess they probably don't have it figured out how that's going to work, but yeah, that's huge. Okay, so Gavin, what's something you're going to be pretty concerned with in the next 40 years?
Probably after college, starting off with a job, so probably getting a house or kind of find living expenses, kind of get on my own.
Good. So you're looking for stable shelter and to build some equity, build some assets. Okay, good. Michaela?
Well, insurance is a big one, you know, that we've been talking about. You need to make sure that everything's covered.
I mean, I would say health insurance, to be honest, in your generation is gonna, I mean, is just gonna be so paramount. It's so paramount. The amount of your income that it eats up if you don't have it is gonna be pretty huge. And then, so Philip, what about you? What's on your mind, number 1 and 2, let's say, over the next 35, 40 years?
I would say just providing for a family.
Okay, so you're interested in compensation. How am I going to provide for a family? So do you guys on the whole, and there's no right or wrong answer, but like on a scale of 1 to 10, with 10 being like super critical and 1 being I don't care at all, just hold up your fingers how important you perceive retirement investing to be. And I'll hold up mine. Oh, you've got a 10, 6. Okay, Carson's an 8, 4. What do I got over there? 8, 10, 5. Okay, so a number of 10s from young people. Okay, interesting. Because I didn't hear any of you say that. Not one of you said, like, it's really important to me that my employer matches in my 401k. So let me just tell you a little something about that really quickly, and then we'll keep going over here. But if you put away only, so I didn't start saving for retirement until I was 29. I put myself through college, I had student loans, put myself through graduate school, had student loans, you know, got a good job, but had a couple kids, you know, had to buy a car, pays, you know, blah, 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 blah. I mean, I didn't have a penny basically until I turned 30, started saving. And what you immediately found out was, you know, I got a job and the employer says, you know, I'll match you dollar for dollar, up to $3,000 a year. Well, what I'm going to tell you is if you leave one penny of that $3,000 on the table, that is just a ginormous mistake, because we've learned about the power of compounding, right? So if you put away $3,000 a year, all of a sudden that turns into $6,000, right? Because your employer's matching you buck for buck. And then you take that over the next 40 years, the math, I mean, you guys have seen the math. What's the first words out of my mouth when I look at that? $3,000 a month divided by 12 months a year, $250 a month. What's the first words out of my mouth?
Invest.
Well, the first words out of my mouth was, I don't have 250 bucks a month. I've got 2 little kids in daycare. I'm paying for a car. I've got a shit ton of student loans, including grad school. Where am I going to come up with $250 a month? Right? Was my question. And I mean, I hope that I've shared just a few techniques with you this semester about budgeting and doing your spending analysis and your cash flow. And turns out, you know, that we had too much car and we had to downsize our car. And, you know, maybe we ate out too much and we had to downsize that. But I scraped and I found that 250 bucks a month and I got it, you know, my money doubled. So, I mean, without sitting here and lecturing at you, that dollar for dollar match is giant. Even 50 cents on the dollar is giant.
So what you're saying is you put in, I'm not too familiar with 401k, I guess, but the money, because I thought your 401k is money that they take out of your paycheck.
That's the employee contribution. And then not everybody does this, but you're hoping, and many, many, many companies do, because it's the only way to incentivize good young people to come work for them. They match either dollar for dollar or 50 cents on the dollar or quarter on the dollar of what you put in. That's just free money.
Yeah.
Just free money. The university will put in for me dollar for dollar up to 7% of my gross. Wow. You know, do that math over 30 years. Now, you could go to work for a company that has a 401k with no match. But then it's like, dude, what? I mean, I could get an IRA and do the same thing on my own, right? So if you're looking at comparable jobs and one job's offering you 40 and one job's offering you 42, and the $40,000 a year job has a dollar for dollar match, then you've got some math to do to figure out. And again, not just that day, not just that short-term mentality of that's $2,000 a year difference, but that compounding that money over time, that little $2,000 a year, which doesn't feel like much, might be $100,000 by the time you're 65. So good question. Okay, so why do people invest? What are the objectives? When you're retired, that's what you're going to live on. You're going to draw down from it. Major expenditures, oftentimes young parents start like a Section 529 to put away money for college, or they want to start a fund to put money down on a house or start a business. You might also want to be sheltering your money from tax. Do you guys remember what tables we used to do this when we were saving for something like, say, 15 years from now? What was that called? So if I was going to put away $1,000 a year, can I just multiply that by 15?
Future annuity.
Yeah, future value tables, exactly. I have to look at the future value tables. So whatever your goals are, the point of this, and if you ever go to an investment advisor, which you probably will at some point in your life, a good investment advisor, the first thing he or she is going to say, well, are a couple things. One, what are your goals? And two, where are you on the risk continuum? And I think we did this like the first or second week, and we all kind of went around and we could identify, like, are you risk averse or a risk taker? And generally, like, if for fun, I like to, ski off a cliff and mountain bike, across a chasm and, skydive, I'm probably going to be a risk taker financially if I'm a pretty like low risk person. And, I'm probably going to be like that financially too. The second thing that an investor is going to do, or an investment advisor is going to do, is like, if I walked in when I was 30 and I'm like, I want to retire when I'm 50 and I want $200,000 a year of income. He's going to be like, you're a community college professor. That's probably not going to happen. So your goals have to be aligned with, the reality of your life. Okay, so how do I get started? This is just the same that we talked about with setting up a savings account. You've just got to regularly allocate a small portion into an investment fund. And you can go online and start like a little Charles Schwab account or a Jack White or a whatever, E-Trade, and put your little $50 a month in it. I talked both of my kids into doing that. And one of them happened to get into cyber currency right at the right time and turned $1,000 into 10 grand, and it could have gone the other way just as easily. But the point is, you don't have anything unless you start really small and just put that little chunk in every month. These are some links. Of course, they want you to end up subscribing to their newsletters, but there's some really good freebie information on Motley Fool, Morningstar, Kiplinger. And some people get into this and they love it. Like they really, really get kind of hooked on it. Always, 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 this is called dividend reinvestment. So that means like at the end of the year, I'm going to make $2.83 on my Apple stock. Do I want them to send me a check for $2.83? No, I want them to buy another, 0.009 shares of Apple stock, right? So that's called dividend reinvestment. You just keep reinvesting in more of the same. Okay, so how much money is it going to take to get started? Do you have a lump sum of money to invest now? Well, that doesn't describe most people unless you've inherited or been gifted or sold a business or an asset or something. Most of us don't just come into a lump sum of money. Most of us are having to like regularly work at it, right? Systematically building an investment pool. Okay, let's see, what does this mean? Okay, so we talked about two things when we did future value, present value. Well, we talked about a lot of things, but one of them was if I put away, $5,000 a year for 30 years at 8%, what am I going to have in the future? Okay. That's future value of an annuity. What's it called if I know, which I don't know how you would know this, but say I did. I want, like a lot of people in my generation hold that magic retirement number out as $1 million. I want $1 million and I'll be able to retire. I mean, that's nonsensical, but I hear people say that all the time. So say at your age, you're 20. I want $1 million when I retire at 65. How are you going to figure out how much to put away a year? What's that called? Anybody remember? Shasta, you remember what that is? So say you have a goal in the future.
Is that present value?
Yeah, is it present value of an annuity or present value of a lump sum?
A lump sum.
Really? So you're just going to put a big chunk of money away?
Adding money every month.
Yeah, it's probably going to be an annuity. You're going to put it away over time, right? Most of us are going to do that. So one of the questions before you can go to the tables, right, is what percentage am I using? And for most of us, it's like, I don't know. So just so that you get an idea, this is stocks, the Standard and Poor 500. These are the 500 most volume traded stocks on the stock exchange. United States Treasury bonds, we've talked about those. That's what the government issues to cover the debt, right? And then US Treasury notes are shorter term. So if you look at a 5-year time period, or a 10-year time period, or a 15-year time period, or the entire history of the New York Stock Exchange, here are the rates. So all of a sudden, when I tell you that like 7 to 8%, that's a pretty conservative return over time, isn't it? If you're in stocks, it's a pretty conservative return. You can use this to say, you know, I think, you know, like at my age, I've got 80% in really low yield stuff because it's super safe, and only 20% over here. Well, then I can kind of figure out what kind of weighted average return I'm looking at. For those of you that are super young, you might have, here's kind of a funny rule of thumb, and this isn't advice or anything, but I've heard this a number of times, and I think we've sort of roughly stuck with it, that however old you are is about what percentage you should have in really safe stuff. So if you're 20, I'm gonna have about 20% of my investments in like money markets and bonds and really safe stuff. And I'm gonna have 80% of it in like stocks and EFTs and real estate. But when you're 60, you know, that's flipped, right? So that's just a very, very random rule of thumb. Okay, I want to talk about these pretty quickly. I'm just going to go around and see if you guys can all crank this out. So Carson, if I invest in common stock, how do I make money? I'm buying stock in Facebook. How do I make money? 2 ways.
I mean, you buy it at a certain price, and then when the selling price gets higher, you sell it and make a profit.
That's one.
I don't.
Anybody jump in.
You can short the stock where you purchase the stock at a value and then you sell at an agreed value that's lower. Then you somehow make money.
You do. That's the opposite of it appreciating, right? Like you think it's going to go down. So like when Tesla was really high and then it took that dive, a lot of people shorted it. That's a little beyond our scope. The other way generally that you make money, Michaela, you should know this. How else do you make money on common stock? Not to put you on the spot.
Dividends.
Yeah, you get dividends. Once a quarter or twice a year, the board of directors gets together and they're like, we've got X amount of cash. We want to reward our shareholders and we're going to send each of you a check for $3.86 for every share you have. That's called a dividend. Okay, that's the 2 ways you make money on common stock. Common stock's very volatile. Okay, bonds. Cameron, how do you make money on bonds?
It's just an agreed upon time, right? Like
Well,
sorry, Cameron.
I get confused with bonds, or where like you can sell it when it's higher than you bought it from, right?
So bonds, do you guys want a general description of what a bond is? Okay, yeah, let me back up. Sorry, I'm assuming maybe that you've got a little more background. Okay, so a bond is when a company wants to borrow money. So when, say, I don't know, Oracle Inc. needed $100 million because they were going to move their markets into South America. It's usually, I mean, it's big amounts of money and it's huge strategic shifts. Okay, I need $100 million. I'm Oracle. I have, well, 3 choices. I can sell some stock, raise some money, get my 100 million. I can go to the bank and try and get a loan and pay interest, or I can issue bonds. If I issue bonds, I go to the stock and bond market, to the New York Stock Exchange, well, actually the bond exchange. And I say, I've got $100 million worth of bonds that I want to put out there. And you guys all buy them in $1,000 increments. And then they agree to send you a check every 6 months for whatever annual interest rate they're written at. So the way that you make money on a bond is they pay you interest. Bonds are very stable. Their prices might go a little bit like this with inflation, or a little bit like this with economic downturns. But when you buy a bond for $1,000, it maybe goes up to 1,002 or down to like 998, but it's not, it's certainly not like stocks. So they're much more stable. They're much more safe, and they give you a guaranteed yield. When I bought, Dell Computer 20 years ago, when it was still in Michael Dell's garage in Austin, nobody knew that the stock was going to go from $2 a share to 20,000. Well, I didn't do that. I wish I was that clever. But, so the people that did that made $19,998 on every share of Dell stock that they had. That's never going to happen with a bond. You're going to get your interest check. And then at the end of the life of it, like 5 years or 10 years or 20 years, you're going to get your $1,000 back. Super safe. Okay. So common stocks, you make money with appreciation and dividends. Bonds, you make money because they send you an interest check every 6 months. A preferred stock is actually stock. It's shares of ownership in the company, just like common. But what's different, they're more bond-like than stock-like. In other words, they have a fixed dividend rate, so you're guaranteed a set amount every quarter or every 6 months. And they do fluctuate in price, but not a bunch. So like the most conservative of these things is bonds. Then the next most conservative is preferred stock. And then the wildest ride is common stock. Mutual fund. Anybody want to take a plug at defining what a mutual fund is?
Don't you just pool money with a bunch of other people and then a person invests it for you, like as a group?
Yep, that's exactly what you do. So all of us give, XYZ mutual fund our $200 a month in our 401k. What does the mutual fund invest in? It depends. Did I invest in a renewable energy mutual fund? Then they buy all renewable energy stocks. Did I invest in an international bond mutual fund? Then they go to, Singapore and Bolivia and invest in international bonds. Did I invest in a gold mutual fund? Then they buy gold, right? So you designate, rather than just buying Apple, I buy the tech 20, top 20 tech firms. So my $200 a month goes into Apple and Google and Facebook and Snapchat and TikTok and right? That's a mutual fund, but they're directed towards very specific objectives. It can be an industry like tech or what else did I just say? Renewable energy or gold, or it can be like, I want to go into emerging markets like India and Russia, or I only want my money to stay in the United States, or I only want my money to go into, they're called the dog of the Dows, the really old American companies like, IBM and Johnson & Johnson and GM and, so depending upon where your value set is, that's where your professionally managed portfolio goes. Okay, stick with me here. An exchange traded fund is called an ETF. And those trade exactly the same as an index. So for example, an index is the S&P, the top 500 stocks in the country. So if I bought an S&P ETF, lots of acronyms there, my one share of my ETF would have all 500 of those companies in exactly the same relationship to each other as they are on the big exchange. So that takes most of the management out of it. And then real estate. Okay, what I can see we're gonna need to do, because we're running out of time, I'm gonna do a couple more screens here, and then I want to spend the last 20 minutes doing some calculations so you're prepared for your homework, okay? All right, so where do these financial instruments trade? Well, there's primary markets and there's secondary markets. Primary market, we're not even going to really worry about. I'm a brand new company. I want to come into the market for the first time and sell some stock and raise some money, right? Airbnb just went public. TikTok just went public. What's some other big names that have just gone public? That's called, anyone know what this stands for when you go public the first time? IPO, an initial public offering. IPO. So this is for investment banks, and you and I aren't involved in primary markets. We're on the secondary market. So Airbnb sold, they sold, I don't know, $500 million worth of stock, and now a bunch of people own it, and now they're going to start buying and selling it. Okay, that's a secondary market. The New York Stock Exchange, the American Stock Exchange, the NASDAQ, which is where all the tech stocks trade. OTC, the over-the-counter market for really tiny little penny stocks that you and I wouldn't recognize any of the names. They're just really small startups. So these are secondary markets where you and I can trade our stocks and bonds with each other, and mutual funds. Okay, I wanted to show you this really quickly. Where am I at? No. Okay. So I'm sure you've heard these terms, right? Bull market and bear market. When stock prices are rising, it's called a bull market. And we have essentially, I mean, probably anybody that's really in this world would laugh at me saying this, but we've essentially been in a bull market since about 2010. We've seen, lots of these, but really basically an upward trajectory. When prices are falling, we're in a bear market. And here it says right here, the past 50 years have been generally bullish with significant exceptions. These 3 years were all dot-com busts, 2008 and 2011. So I guess my statement was kind of accurate. From 2011 till now, we've been in a pretty solid bear market. 2008 was the second worst crash we've seen since the early 1800s. And then I'm not going to take time to do this right now, but it's very interesting. It took me a second to kind of interpret this graph, but page 438 shows per year over the last almost 200 years what percentage the market's either gone up or down. 0 to 10, 10 to 20, 20 to 30, whether it's gone up or down. And you can see it's about even. But on the whole, we just saw that it goes up. I never knew this number was this high. None of us are going to be in the market for 91 years. But I mean, that's a pretty good freaking yield. Okay, this is probably a little above our pay scale. There's national exchanges. You can trade on the Tokyo or the London or the Johannesburg or the New York. So again, these are big traders. Regional exchanges are like the Seattle Exchange or the Chicago Exchange. So they're more regionalized. So what many of you guys will do, because you're young, is you're going to not have a broker. You are going to be probably online doing your investing. And this is really, really important. My husband and I use Charles Schwab for what we do. And I was like, oh gosh, they're only got a 3.5 rating. This is when you take your $50 a month and you sign up with Interactive Brokers or Fidelity or E-Trade, and you send it to them. And by the time you get $300, you're like, I'm ready to make a buy. I'm going to buy a half a share of you know, whatever. I'm going to buy a half a share of GM. Or I just saw Hummer was coming out with their first electric EV Hummer. Okay, I'm going to buy some shares in Hummer. And then you've got that account. And if it goes up a little bit, you're like, I'm going to sell it. I bought in for 500. It's at 8.25. Sell. I just made 325 bucks. First question is, did you really make 325 bucks? Oh, you know the answer to this. What happens when you make money? You have to pay
Capital gains.
Yes, you have to pay capital gains tax. So you can't quite get too cocky. You didn't really make $325, but you get my point. So these are different kinds of online brokers. There's nothing magic about getting an online broker. And you just kind of go sign up and you start sending them money and then you make trades. And you can use those links that I gave you earlier on to help inform you. If you're like me and you're really risk averse, when I was young, well, still actually now, it's really terrifying, this constant thing like, oh my God, maybe I'm doing the wrong thing. But there's tons of calculators online that help you look at how much you should allocate to stocks and how much to bonds. And just rest assured, there is really no magic answers. I mean, millions of people spend their whole life over computers trying to outperform the market. And what we know from research over time, that even the best statisticians don't outperform the market over time. So, I mean, that says something, right?
Do online brokers, oh, sorry.
Go ahead.
Do online brokers take a commission fee or?
Yes.
Hmm.
Yep. And I would guess, I certainly didn't have time to look into this, but I would guess that's a huge play in how they rank.
I'm actually pretty sure Fidelity doesn't. What they do is they invest money that you have sitting in there, and they take dividends off of that. So that's what they get away without charging you. So it does look like a really good deal. They just invest your money as, like, so you have $300 just sitting in Fidelity, not invested. They take it and invest it.
Okay, so this is where we're going to spend. Hold on a sec, sorry. Water down my pipe again. This is where we're going to spend the rest of our time learning how to calculate an investment yield or a return, because that's what you're going to do for your homework on Tuesday. And this is really important. We talked about the two ways that you make money on stocks and how you make money on bonds. And a savings account is basically just the same as bonds, you just get interest. So we wanna, I'm looking at 2 or 3 different stocks, and you know, quite honestly, all of the online platforms are gonna do these calculations for you. They're gonna show you the yield per year and over time. But I think it's important, we're in a personal finance class, like, how do you calculate this? So this is basically how you calculate rate of return. And it's basically the 2 things we talked about. I asked Carson, how do you make money on a stock? And he said, well, you sell it for more than you bought it, right? That's ending value and beginning value. So this, if you want to write this down, that makes a little more sense for you. It's like, you know, this is selling price and this is cost. Okay. So that's your appreciation. Plus, I get some income. I get dividends, or maybe not, but I mean, hopefully. And I need to divide all of that by what I paid for it. And that's going to give me a rate of return over the number of years I've held it. Right? I've held it for 3 years. I've held it for 8 years. We know that everything in the finance world has to be translated to an annual percentage, right? An APR. So then we're going to have to divide it by how many years I've held it. Okay, so this is just 1 year, so this is going to be really easy. You bought 100 shares of Walt Disney. And by the way, when you see those letters after the name of a company, that's called the symbol. And that's when you're going like to look up what it's traded on a stock exchange, you put in the symbol. So Disney is DIS, right? Tesla's TSLA. I mean, they're all, Verizon's VRZM. I mean, they're pretty intuitive. So you bought them at $101.60 a share. And in 1 year, it's gone up, it's gone up, and it's now trading at $112.02. And they gave me $1.68 per share. So since this is only 1 year, you can just do this calculation without dividing by anything, and you're going to come up with the rate of return. Make sure when you do the ending value and the beginning value that you multiply the per share price by the number of shares. Are you with me? So go ahead and do the math. And this really, I guess, to make this, there should be parentheses around that ending value and beginning value. So, 100 shares times the difference plus 100 shares times the income divided by 100 shares times the beginning value. So go ahead and calculate that out. Okay, we ready to look at the answer? So 100 shares times ending value minus 100 shares times beginning value. Plus I made $1.68 dividends, right? For the 100 shares divided by the original 10,160. Based on everything we've just talked about, how do you think Disney performed?
That's pretty great.
Yeah, you feeling good about that? Okay, let me introduce one other little caveat here. Based on everything we've looked at, I totally agree with your assessment. Last year, the S&P did 18.5. So now how did Disney do?
They underperformed the market.
Way underperformed. Why? Because they had to close in freaking April. The pandemic. Okay, I'm just making all that up. These numbers aren't even from 2020. But my point is, you look at that and go like, wow, woo. But then you've also got to ground yourself and go like, well, how did the market as a whole do? Or is that an appropriate return for how much risk I took? Right? If this, we all know that Walt Disney isn't a risky company, but like if I had invested that in a new, like one of the hot tips I've gotten recently is a company that's designing electric EVs, electric vehicles, but they're buses, right? With the thought that nothing's gonna run on, a 4-stroke engine and fossil fuels in say 25 years. So, okay, buy some Nikola, which is the name of the company. Would I be excited with 12% on that? Why or why not? Cameron's shaking his head no. Why would I not be excited with 12% on that?
It just seems kind of low.
Well, but so compared to what? So Disney does 12%, the rest of the market did 18. Okay, so it's underperforming, but it's a pretty low risk company, wouldn't you say? My question is, what happened if I had made an investment in a really new startup that's got really revolutionary technology and it showed me 12%? Have I gotten the return that I should for the risk that I took? So that's the question, right? You always have to do that risk return balance. I thought we had one more that we had to look at. Okay, so let's take a look at your homework. So we're on, let's see, I've got to go back and look at what numbers you're doing. Hold on. 5 and 14. Okay, 5 is what we covered today. So I would prep that, get that ready, and then we'll take a look at how to do 14 on Tuesday, and then all the homework's due at 11 o'clock that night. But so to kind of get you started, so number 5, sorry, is on page 466. And it's asking you which of the following would offer the best return on investment. Assume that you buy $5,000 in stock in all 3 cases and ignore interest and transaction costs in all your calculations. So transaction costs is when you have to pay commissions. And so the first one is you buy without margin at $60 and you sell it. The second is you buy on 50% margin, and then you buy with 75% margin. And gosh, I'm sorry, I didn't really show you how to do the margin calculations. So let me show you where to go to get that. So do you guys know what margin is? You ever heard that term? So margin is when you borrow from your stock broker to invest in the market. So, I mean, you've got to have a good deal of your own money in the game, but I'm just looking for the page while I'm talking to you. You say like, I've got a couple $100,000 in my account and now I want to invest $500,000 in Nicola because I think this is going to be amazing. Can I borrow $300,000 from you to go into the market? Yeah, I'm sorry, I didn't read that all the way through. You don't need to know how to do that. Let's just don't worry about any homework for Tuesday. I think I'm going to just change this to just doing number 14. I'm sorry, I didn't catch that it was a with and without margin. That's a little beyond what I want to take you into. So what you need to do for your takeaway from this then was just make sure that you know how to calculate that basic return. And let's just practice one more and then we'll call it a day. So I want to try one over multiple years. So let's say that I buy 50 shares of Starbucks on 10/1/16 at $61.25. Oh. And then I sell it so what is that, 5 years? Over 5 years, I received okay, so I've got these shares of Starbucks. I bought them for $61.25. I sold them for $90.57. And in total, so cumulatively over the 5 years, I got $24.46 per share in dividends. So, and I want to know, obviously, it's always annual, right?
Lisa,
Mhm.
what do we divide all that by?
The beginning value.
So Lisa, in
Yeah.
the last example, it was only 1 year, so it was just divided by 1, so it was that answer. But would this one be divided by 5
Yes, ma'am.
instead? Okay.
Oh. So is this what you guys got? A total of 81.28? Great. And then an annual 16.26. Okay, I just made those numbers up. I don't think Price Star